Welcome to the All Together Show. I'm your host, Eric Satz, and with me today is Brian Feroldi. And did I say Feroldi right? That's
You did.
important.
Well done, Eric.
Excellent. Brian, this is a first for me because this is the first time that I'm doing a show with someone I'm meeting for the first time, like in real life. So this is kind of exciting. And thank you for agreeing to connect over, I think it was Twitter, and then agreeing to be on the show. I really love what you have to say and what you write in terms of financial wellness and how you think about the markets. And so, by way of background, Brian is he's an author, he's a speaker, he's a YouTuber. That's the thing. He's all having to do with financial wellness and financial health. And so, Brian, welcome to the show.
Thanks, Eric. Great to be here. And this is my favorite thing about Twitter. Twitter, by the way, is Twitter gets a bad rep in society, but the amount of people that you get to meet because of Twitter, the amount of people that I've met because of Twitter is just astounding. So I love Twitter.
I totally agree with you. So, I gave a sort of brief background, very high level, macro level in terms of who you are and what you're about and how you're contributing, I'm going to say, to society today. But in your own words, who's Brian Feroldi?
Yeah, the funny thing is when people come up to me and they're like, so what do you do? I always have a hard time describing it. So I've just gone with the generic term, financial educator. But I am an author, a speaker, as you said, a YouTuber, which is wild to me that I'd be saying that, but I guess it's true. But I am very passionate about creating content that helps anybody do better with their money. I'm particularly known for helping people kind of figure out the stock market, and I am someone that personally invests the bulk of my net worth into the stock market. So it's something that I study and follow very, very closely. But I also love talking about personal finance, money, mindset, betterment, and spreading any of that information any way that I can.
So that's super to hear. Thank you. But I actually want to go way back. I want to start at the beginning. Do you mind telling us where you were born? Do you have siblings? What did your parents do? What is the start of Brian's life like?
Sure. Born in the early 80s. I was actually born in Kentucky, lived there for all of 2 or 3 months before my parents moved to Rhode Island for work. My dad is in accounting slash finances for corporations. He's currently the CFO he was the CFO of a company. He has since pulled back and is semi-retired at this point. My mom worked for a local charity, the ALS Association. So her job was fundraising for a nonprofit. They kind of got their foot in the door, their name on the map with the Ice Bucket Challenge a couple of years ago. So so she that was a banner year for her organization when that happened. But I grew up in the woods. Very rural town, 5,000 people in western Rhode Island, and very small. I went to a very small high school, just 120 kids in my graduating class. From there, I went to stayed in New England. I went to University of Connecticut, bounced around Massachusetts, Rhode Island, New Jersey area for work. Ended up coming back to Rhode Island about 15 years ago, and have been here ever since.
So we skipped over the siblings. I don't know if that was intentional or.
Oh, sorry.
Or
Yep, I'm the middle child, so I have an older brother and a younger brother.
Great. And are they in the area too? They still in Rhode Island?
Yep, my older brother is lives in the same town that I do. My younger brother lives in Massachusetts, so we're all nearby. Get to see each other fairly regularly.
Fantastic. So, any sort of more influential years as you were growing up? Like, was high school more important or informative? Was it college? What just some insight there would be great.
Yeah, shaping the person that I am today, I would say that college was more informative. I really had a great time in college. I firmly believe, by the way, I exited college dumber than I went in. But man, did I have a great time in college. Made some friends, and college is the way that I did it was almost like living on your own with training wheels, right? Because your food was taken care of. You didn't have to like freak out about having a job and kind of figuring all that in, but you were discover on your own. And I just had I had a great time in college. I got fine grades, and I graduated with a business degree. But very little that of what I actually learned in college, I would say I applied to my real life. I could say that I learned academically. Everything that I really learned in college, I learned from living on my own, from dealing with people, from making friends, from networking, from dealing with difficult people, from being in interesting situations. So that, I would say, is the actual education that I got in college. I also met my wife in college, so that, I guess, was the biggest payoff of all there. But college shaped my personality. I would say that the years between 18 and 25 shaped my personality the way it is today more than any other time.
That, it's really interesting to hear you say that, because I think online education can play a really important role in the world with respect to information transmission. It cannot replace the experience that you just described for us.
Mm-hmm.
And I think so important and so underappreciated. One of your tweets that I really like has to do with underappreciation. It says, underappreciated wealth hacks: work you love, minimizing risk, resisting lifestyle creep, finding your level of enough, avoiding debt and financial leverage, keeping the same car, house, and spouse. You're a poet.
Thanks. Yeah, that's one thing about Twitter is it forces you to think through ideas, boil them down to their core, format them in an aesthetically pleasing way, and transmit it in literally as few words as possible. That's actually a really, really useful life skill. The education you can get from just being on Twitter and reacting to seeing what works and doesn't work, I would say, is a far better communications degree than you could actually get in college.
So I think I know what you mean, but I'd love to hear you just expound upon resisting lifestyle creep.
Mm-hmm.
What should people be thinking about when they read that?
Hopefully people that are listening are familiar with the hedonic treadmill. It's basically as your circumstances improve, you upgrade your lifestyle to meet those new circumstances. That's a very well-known phenomenon that happens. If you go from making 40 grand one year to 60 grand in the next year, if you're normal, your expenses are going to grow from 40 one year to 60 the next year, and they're going to essentially move in lockstep with your income. That's called lifestyle creep. Now, there's nothing wrong with a certain amount of lifestyle creep, especially when you are just starting out and your income is very low and it rises rapidly. Like, nobody wants to live in a dorm room forever. People want to buy their own house and have their own place and, afford their own car and all that kind of stuff. And all that costs money. It's just that it's very common for people to overdo it themselves, to advance their lifestyle faster than their income grows. And a lot of people fund the difference with debt, and they rely heavily on debt, which makes their personal balance sheet very, very fragile. And that's all well and good when your career is on the rise, everything's going well. But if you're going through a time like we're going through right now, having a balance sheet that can support you when potentially through a layoff or a health emergency or something like that, I think is just absolutely critical to proper financial health and financial wellness. So learning to resist lifestyle creep is hard to do, but once I think you hear the term and you understand what it means, it becomes easier because it's in like your sphere of influence. And one simple way to kind of do that is, every time you get a raise, just rather than spending all the raise, just force yourself to put half of it into a savings account, or half of it into investments or something like that. That's actually the least painful way to increase your savings rate, is to save more of your future income that you don't have. So just like a couple little nuggets like that I thought were worth sharing.
So you say avoid debt and financial leverage. Do you mean avoid all debt and financial leverage, or is there a rule of thumb, a benchmark by which, people can sort of look at and say, you know what, that's an appropriate amount of debt or leverage on my balance sheet?
Mm-hmm. not all debt is created equally, and I fully acknowledge that people have different mindsets and different thoughts about a debt. And one downside to Twitter and tweets is there's nuance to absolutely everything. Absolutely everything related to finance, to money, to investing, to the markets has tons and tons and tons of nuance, but nuance doesn't transmit well in 144 characters, wherever the current limit is, or less. So broadly speaking, if you were to say, sum up your philosophy on debt in 2 words, I would say avoid it. Right? Just have zero debt. That's a very easy way to summarize it. But on the debt spectrum, there's different types of debt, right? The worst, the quote unquote best kind of debt that you can have is a mortgage, right? It's low. It's a low interest rate. It's tax deductible. All of that benefit has largely been disappeared for most Americans. It allows you to afford something. It forces a savings rate upon you. So as far as debt goes, a mortgage of all the ones to have isn't that bad. A small level of college debt is okay if it's an acceptable amount and you truly use that money to advance your career, to land a job, to increase your income. So a small amount of college debt isn't the end of the world. It's really the consumer debt that gets most people into trouble when they buy more car than they can afford, if they buy jet skis, or if they use credit cards to go on vacations or those kind of stuff. That's the kind of debt that is like, obviously you should completely avoid that. And like the buy now, pay later thing. Buy now, pay later is absolutely huge, or at least it was more recently. And it's like it's selling your future income at a discount to provide for consumption today. By and large, if you're choosing to do that, my general thought is don't do that. Do that if you have to. Do that. But most people choose to do that. So I'd rather just say keep it simple by saying avoid debt, zero debt. Both those things sound nice and are good life philosophies.
Two things now come to mind. What do you think is going to happen in the buy now, pay later space? Obviously, there are some big public companies that were built on BNPL. Mm-hmm. Interested in your thoughts there. The second thing is, that's the first time I've heard someone phrase what BNPL is to the consumer in the most concise and accurate way. But I think it may require explanation. And so what you said was that you are selling your future income, your future cash flows at a discount. So I'm going to ask you to take that question first and say, can you please explain what that discount means or is to the audience? And then get your thoughts on stocks that are playing in the buy now, pay later space.
Well, that's but all debt is. All debt is pulling forward consumption today in exchange for paying more for that down the road, which is in a very real way, committing your future self to work, committing your future self to make money, committing your future self to give that money away to somebody else, and overpaying for the right of using that today. That to me is selling future income that you're obligating yourself to do today at a discount. Buy now, pay later is, I would say, good in some ways in that it avoids interest and you know what the numbers are and all that kind of stuff, but it's still taking a consumption that's is still tying up your future income to finance purchases today. For some people, that's the only way that they can afford their life. And obviously, there's like everything, there's tons of nuance to this, but by and large, if you can avoid buy now, pay later, if you can avoid debt, I think you should do so.
You know, what's interesting is buy now, pay later is a name we've given to an industry today, but it's really existed for a long time, right? So whether you're buying if you're a farmer and you're buying a huge tractor from John Deere, or you're just an everyday individual and you need to get from home to office, well, so a lot of people don't have to get from home to office anymore. But when people used to drive to work, right, and they would buy that car, we talk about the transition of GM and Ford and other car companies from automobile makers into finance companies. Mm-hmm. And those like, hey, you can afford it. We'll give it to you. You're just going to pay us more over time. And so, but we gave it a whole new a whole new name over the last kind of 5 years, which makes it sound pretty sexy. What do you think is going to happen to the buy now, pay later companies? And my sense is, just looking at you right now, that maybe you're looking at some tickers and some statistics. But what do you think happens in this particular environment?
That's a good question. I would say that it's clear, at least the short-term trends, is that consumers want buy now, pay later. Consumers value buy now, pay later as just a thing. And we've seen companies like Afterpay, like Klarna, like I'm trying to think of the other ones, Affirm, that are out there, and they've had tremendous growth over the last couple of years, and they make it very clear that consumers like that. And there are positive attributes to buy now, pay later, right? You know what you're paying, you know what the rates that you're paying. There are no gotcha surprise things. It is better, I would say, to use that than to use a credit card. The sustainability of their business models is still up for debate, and those companies largely were funded by venture capitalists over the last 10 plus years who were willing to invest at very, very high valuations. And those companies have operated at losses as they've grown to become more and more popular. What happens now that essentially the venture capital markets aren't shut down, but are pretty close to being shut down? I think I saw, was it Klarna initially raised, I'm going to make up these numbers, but directionally accurate, just raised at $45 billion valuation like a year ago, and they recently raised it like a $4.5 billion valuation. So literally their private
Discount.
market valuation drops by 90% or something like that. That might change the economics of the business and what they can afford to consumers, and that might make them make their business model less attractive. So I don't know. I would put that in my too hard to figure out a pile. And I broadly speaking, avoid making predictions about anything because I don't think that anybody can make predictions.
So we can, but whether or not we're right is anybody's guess.
Correct.
So let me ask you a question, because the people who think they have a really clear crystal ball, those people also are on Twitter and like to talk about it a lot. And it's always interesting to see the other side of those conversations, let's call them. But my sense is that you're not just picking mutual funds and ETFs and indices, but you're actually building a portfolio of companies that you've done homework on, and you are placing bets with. Is that accurate? Do I have that right?
That is correct. So, but broadly speaking, if people come up to me and they ask me, what should I invest in? I'm interested in the market. What should I invest in? My default answer is always the same: index funds. Period. End of story. Index funds. I think index funds are the right choice for 98% of the people, maybe even 99% of the people out there. However, if you are in that 1% of the population that is literally interested in the stock market, literally likes digging into SEC filings, likes listening to conference calls, likes studying businesses, likes understanding investor psychology, which I am in that part of. I literally get joy out of following, buying, and researching companies. Like, the entire process of investing is just something that I find tremendously fun and intellectually stimulating. For that reason, in addition to the index funds that I just put into my retirement accounts, I buy and hold individual stocks.
You're stabbing me in the heart. Okay,
what?
Go on. Sorry.
I buy and hold individual stocks. I own about 80 of them or so. My top 20 positions make up about 60-70% of my portfolio in general. And I enjoy the process of following, keeping up with them, buying from them, learning from them. So I am someone that really enjoys following and studying the market. But I know that bores to tears 99% of the population, which is why for them, I just say, don't worry, you don't have to know anything. Just stick to index funds and you'll do great.
But if you're okay, I'm going to say it this way. What does you'll do great mean? I'm going to take the opposite side of this conversation, Brian. What buying index funds? What does you'll do great mean?
You'll do great means the odds of you earning a positive market, inflation beating return and getting the highest return on your investment over multi-decade periods is exceedingly high. My favorite statistic about the S&P 500 is that if you, an investor, bought and held the S&P 500 for a 20-year period, the odds of them making a positive real return, positive meaning after, a real return meaning after accounting for the effects of inflation, are 100% of the time. 100% of the time, historically, if you've bought the index fund and held it for 20 years, you've made money. That includes investing at the worst possible times. The absolute peak, September 3rd, 1929, right? January of or March of 2000, right? When the NASDAQ was at its peak. If you buy and hold the index funds for the appropriate amount of time, that's the key part, the odds of you doing well are exceedingly high. And if you are dollar cost averaging into them, buying every week, 2 weeks, or month, best case scenario is the market goes down and stays down for a very long time. That is literally best case scenario. It might not feel like best case scenario while it's happening, but that means that you're buying at better and better and better valuations moving forward.
So just it's not really an aside, it's directly related. Dollar cost averaging. You mind quickly explaining that for folks?
Mm-hmm. Dollar cost averaging is investing a set amount of capital into an investment on a predetermined schedule. So if you have a 401k, you are dollar cost averaging. Let's just pretend $100 is leaving your paycheck every $500 is leaving your paycheck every 2 weeks. So you are investing $13,000 per year into whatever your investments is. If it's just in a broad-based index fund, you're buying $500 worth every 2 weeks, regardless of what the price is. If when the price is up, you are buying less shares, same amount invested. When the price is down, you are buying more shares, same amount investing, but it's committing to investing a set amount of capital on a preset schedule continuously.
And sticking to it.
Which is very easy to do if you have a 401k. That's one of the magics of things like 401ks is you set it up once and then you can just forget about it.
So, one of the things that you've also said and tweeted is that within your control is your investing process. What's not in your control is the timing and magnitude of your results. Mm-hmm. So what you've just said, though, to us is you got to be in the market. If you're in the market for 20 years, you're going to be just fine, so long as you can sort of stick with it. What is also known about us humans is that we are terrible traders. And although we all know we're supposed to buy low, sell high, theoretically, ignoring dollar cost averaging for a second, people have market exuberance and they buy when the market's going up and they sell when the market's going down. What do you say to folks to try and mitigate that psychological and very human risk?
Mm-hmm. We humans were born and we are psychologically programmed to be awful with investment. Like that. Yes. That is how we are all programmed.
So
we are programmed to feel tremendous amounts of pain when our investments go down. We are programmed to take our cues from other people. So when other people are feeling excited and frenzied and buying, that's when we most want to invest. And when the market is plunging and everyone's scared, that's when we least want to invest. And that's when we're most tempted to pull things out. So my broad message to them is set it and forget it, right? That just is the easiest thing to do. But I think that one of the biggest missing pieces of education out there is that so many people have no working knowledge of what the stock market is and how it works. And I very much include myself in that bucket. In fact, I would go so far as to say my rough guess is that if you asked 100 million Americans have money in the market, I would guess if you could somehow magically poll them and say, why does this go up? Why has historically the stock market been the thing that outperformed bonds, gold, real estate? Why has the stock market gone up over time? I'm guessing you'd get the wrong answer 99 of the time, because we're never taught about the connection between what the stock market is, what businesses are, and what drives the returns of the market over long periods of time. But I do believe once you study that and understand that and can truly embrace it, that it makes it so much easier to deal with declines. I view it as the same thing with like flying, like getting on a plane. I'm a nervous flyer. I don't like being on airplanes, right? They're just not for me. And every time you get in an airplane, before you know anything about Bernoulli's principles, the laws of motion, about airfoils and the Wright brothers, before you know any of that, it's magic. You sit in this metal tube, and it's got these arms, and suddenly me and thousands of pounds are in the air. And then when you hit turbulence and it starts to decline for any reason, you're like, like you get instantaneously scared because you're in it and it's like, oh, we're up here magically, right? I don't understand what's going on, but I just know for myself, once I understood how planes work, understood things like Bernoulli's principles and buoyancy and the airfoil and the law, Newton's laws of motion. Once I fully understood the how and the why planes go up in the air, at least it was easier to psychologically calm myself down when the plane was going in the wrong direction, because I understood the principles of why a plane was going up in the air. I think the same thing applies to the stock market.
And so what do people need to know about why a company's share price and therefore enterprise value theoretically will go up as opposed to down? Mm-hmm. And I think and especially when nothing changed from a month ago to today with respect to an individual company, why might its share price be 30% lower today than it was, a month ago?
Mm-hmm. So I think it's important for investors to understand that there's a very basic connection between what a business is worth, or what a rational person would pay for that business, and the current and future profitability of that company. Let's say, Eric, that you started a business and you had a coffee shop, something very, very simple. This coffee shop made $0.
I did, by the way. You didn't know that, okay. But I did have a coffee shop.
Let's say this coffee shop lost money. Okay, so you took in less revenue than it cost you to make. So your bills were higher than your revenue. You had no prospects of ever changing that. And you came to me and said, Brian, I have this business. What will you pay me for it? I would say zero, Eric. I don't want anything to do with your business that loses money, because then if I buy it, then I'm losing money. No, thank you. Conversely, if you took that same business and came to me and said, Brian, my coffee shop made $1 million in profit last year, and I'm going to raise prices next year, and I'm going to build a second location, a third location. I have customers that come back to me again and again. My suppliers love me, and I'm making $1 million this year, and I think I'm going to make $2 million the year after that, and I think I'm going to grow it from there. Suddenly you said, I'm interested in selling. You're interested? I would be like, yes, I want to buy that thing. I would like my bank account to go up by $1 million by owning this asset. So if you understand that, you understand that there's a direct connection between the profits that a business makes and your willingness to pay, for an investor's willingness to buy into that enterprise. Now, that's obviously an extremely overly simplified example, but it does show that when a business has the capability of making profits, it has a value. And if the business doesn't make profits, it should have no value. There's infinity nuance that is in between there, but that's a very basic connection. But let's go back to that coffee shop.
I have two feelings after listening to that. One, I feel like we're on Shark Tank. Two, I'm going to start another coffee bar. It's going to do $1 million in cash flow, and I'm selling it to you.
Perfect.
Coffee bars are really hard work.
Let's start a negotiation. Yeah.
You can have it. So, I want to ask you. Can I ask you? So you do a lot of homework before making an investment. That's clear. But you've also written that you can guarantee that some of the stocks that you own are going to lose a bunch of money for you.
Mm-hmm.
So what happens? What goes wrong? You've done a lot of homework, and you've also said what's really important. By the way, I'm going to tell you, this sounds a lot like venture capitalists. What's really important is that that you have at least one big winner that more than covers all the quote unquote smaller losers.
Mm-hmm.
So what happens in the process? What do investors have to know? Someone who says, you know what, I want to be like Brian. I want to dig in. I want to understand companies and balance sheets and cash flow. What goes wrong, or what have you found a common thread or theme when one of those investments goes wrong?
There's many themes that come up, and the thing about investing in businesses is there's no such thing as a perfect system ever, because the world, when you're making an investment, you are making a bet on the future prosperity of that enterprise. Plain and simple. You are making a bet on the future prosperity of that enterprise. And if you invest the way that I invest, you're often betting on very, very rosy things happening to that company. And the future is unpredictable. Period. It's unpredictable. It doesn't matter how good of an analyst you are. Look at the Federal Reserve. Like, they have have highly paid people.
This, by the way, is why I hate the stock market.
Forecasters, right? Professional forecasters, and they can't even figure out what inflation is going to be, let alone the GDP. How many professional forecasters in January of 2020 could have foreseen what was going to happen 2 months later? Zero.
Nobody.
Zero. Right?
Yeah.
How many professional forecasters could see what's happening right now, say 3, 4, 5 months ago? Yes, there will be people that are waving their hands, say, I knew this was going to happen. Forecasting the future. Oh, excuse me. How many of those professional forecasters had Russia invade Ukraine on their bingo card and incorporated into their models, and oil skyrocketing? The answer is zero. Okay, the answer is zero, or very, very a few. Forecasting the future is always incredibly, incredibly difficult to do. So if I'm making a bet on a company, I'm making a bet on the future prosperity of that company, and then that company has to execute. And there's this really, really pain in the butt thing called reality that sets in, and a company actually has to navigate the world that we live in. And that is extremely hard. That is extremely hard to do. So when I think about, I've bought lots of stocks that have gone down, and I've sold them at big losses. And every time that happens, I get smarter, because I learn another way that the business world can fail, or I can learn something that I didn't know before. And hopefully, I learn a lesson, and I can incorporate that into my process, and that my process gets better and better as I go. But to me, a perfect, quote unquote, perfect process would have like a 50 or 60% batting average, right? I just know no matter what, no matter how much research you do, no matter how much homework you do, the world is difficult, and you're going to be wrong about your thesis a whole lot. However, the magical thing about investing is that you can be wrong a lot. You can be wrong more than 50% of the time and still do great, because you can make 5x, 10x, 20x, 50x, 100x return if you are right on a company, and you can only lose 100% if you are dead wrong about investment. So you can be wrong a lot, but if you are occasionally really, really right, your net returns will be very positive, which, by the way, is exactly how the stock market works, exactly how the S&P 500 works, exactly how the Vanguard total stock market works. People just don't know it, because all of that craziness is just summarized in one number.
So why put yourself through all this? Well, why not just buy that index and then go to the beach and sip a cocktail or play with your kids? I mean, why do all that? Why do all this work to get maybe what is the same return?
Mm-hmm. So I firmly believe that I can outperform the index. And again, I just have fun to tracking that. Like, this is actually my idea of a good time. I enjoy this kind of thing, which makes people laugh. But I'd say, all right, do you know anybody that likes watching baseball? Do you know anybody that likes that is a sports fanatic? Do you know anybody that's really into like knitting or gardening or any other activity? Right? What's the economic value of that activity? What do you gain from doing so? People are just interested in different things, and I just so happen to be interested in finance. If there comes a day when I am no longer interested in tracking my portfolio or keeping up with it, I'll have no problem selling everything, just buying the index fund and calling it a day. But I still enjoy the process of investing. Which, by the way, so do people like Warren Buffett. Warren Buffett could have hung up his hat decades ago. He tap dances to work because he literally enjoys the process. There are weirdos like me out there that just literally enjoy the process.
No, that's it. That's super. I love that answer. So, I know that you wrote for Motley Fool for a while, and I sent you a questionnaire before you came on the show, and you said that David Gardner, who David and his brother Tom were the co-founders and owners of Motley Fool, you said that David was your greatest influence. Can you tell us a little bit about why?
Mm-hmm. And I still work for the Motley Fool. I still do stuff with them. So I absolutely love the Motley Fool. I've learned so much about them. There are many investors that have influenced me and the way that I think about investing. I would say David's style of investing is the most counterintuitive and the one that has challenged my core investing beliefs more so than any other investor, and he has been phenomenally successful at what he's doing. So if you don't know David Gardner at all, he's one of the co-founders of the Motley Fool. His investing style is to essentially swing for the fences. He goes up there and he tries to find companies that he believes can 5x, 10x, 50x, 100x, and he buys them. Many of the companies that he goes after are extremely risky. Perhaps they are just starting to grow their revenue. Perhaps they're unprofitable. Perhaps they're trading at a quote unquote insane valuation. So everyone thinks the company is great, but it's already priced for such extreme greatness. And he has no problem buying companies at 52-week highs, at all-time highs. And pointing out that this company that's at an all-time high right now, at a 52-week high, trading at a valuation that other people think is insane, I'm going to buy that. And it's like, what? Like, there are so many other companies out there that are trading at low valuations that the market thinks are trading reasonably. Why on earth would you put your neck on the line for these obviously overvalued companies? And the way that he invests is he looks for excellence, and he buys excellence, and he wants to buy literally the highest quality companies that he can find. And he goes in knowing that he is going to strike out a whole bunch. He is perfectly okay with picking 10 companies and having 6 of them or 7 of them go down 50% and staying down forever. But occasionally, he recommends Amazon. Occasionally, he recommends Netflix. Occasionally, he recommends Tesla. And those have been such tremendous winners that his overall returns are just fantastic.
So there are 2 things that come to mind when you say that. The first is portfolio diversification. So I want to come back to that a second, because that's implicit in what you're talking about with respect to David's approach. It's implicit in your own approach, and it's not just implicit, it's built into an index approach, portfolio diversification. But the other thing that you're saying with respect to David's thinking is what Buffett likes to talk about, right? There's a difference between price and value. Price is what you pay, value is what you get. Mm-hmm. And to me, what it sounds like is even when David sees something maybe trading at a 52-week high, that price may still not represent the value. And I like the philosophy that you just described. So let me ask you this. At Alto, we talk about portfolio diversification a lot, and we talk about the role that alternative assets can play in a diversified portfolio, and we would argue should play in a diversified portfolio, so that not all of your returns are tied to this thing we call the market, which none of us control. But as you make your investments, and because you're saying, hey, 50 to 60% of my investments may be losers, but the 30 to 40% to 50% may be big winners. What allocation? You said you're invested in I think, give or take 80 stocks, which sounds very Howard Lindzen like. I don't know if you know Howard. Mm-hmm. who created StockTwits. But um, what percentage of your personal portfolio do you allocate to the stock market, and then what percentage might you allocate to a given company, given stock?
So there's two questions there. Let me start with the allocate to the stock market. Broadly speaking, I take a barbell approach to my finances. What I mean by that, it's a tale of two complete opposites. And so my personal finances are incredibly conservative. Incredibly conservative. What do I mean by that? I mean I have zero debt, none, zero debt to my name. I have multiple sources of income, not one, multiple sources of income. I have a high savings rate. I save more than 20% of my income every month. I have a multiple month emergency fund. Currently, it's well over 6 months, just sitting there in cash, losing purchasing power, but doing its job, which is to make me feel better and make me sleep well at night. So when you combine those things together, multiple sources of income, high savings rate, a very conservative, a huge amount of cash, and multiple sources of income. I'm sorry if I repeated myself. When you combine those together, I am extremely conservative with my personal finances. For that reason, I can be extremely aggressive with my investment portfolio, because when we go through times like we're going through right now, which is doesn't matter what you buy, you're going to lose money on it, right? It doesn't matter what you do, your everything, the value of everything is going down. When we go through times like this, which suck mentally, it in no way impacts anything related to my personal life. Nothing. My portfolio could fall 50% from here, and boy, would it be mentally taxing to go through that. However, nothing in my day-to-day life would change or be threatened in any way. So because I'm so conservative with my personal finances, I can be 100% stocks with my investments, 0% bonds with my investments, which is what I am and plan on being for a long time. Now, within my stock portfolio, I have some that's allocated to retirement funds, and those are just set up on autopilot going in there and continuing to buy dollar cost averaging into index funds. I don't even think about them. They just exist. In my individual stocks, I fully understand the argument that Buffett's saying, like, diversification is for people that don't know what they're doing, right? That is a very classic thing to say. A lot of investors say, if it's not a 5% position for me, it's nothing. Like, what difference does it make? I think that the concentration is a scale. Some investors are comfortable with owning 2, 3, 5 positions, that they're comfortable with that. Others want to own 50, 80, 100, 200 positions. And I don't think there's a right or wrong way to do it. The way that I approach it is that I will devote a maximum of 3% of my capital, maximum of 3% of capital to an idea. And that is typically built up over a period of months, more likely years. Once it becomes 3% of my capital, zero. You get absolutely no more. And the company, it's on the company at that point to do the heavy lifting to earn a higher spot in my portfolio. So if you look at my top positions today, which are Tesla, MasterCard, Netflix, or I don't know if it's Netflix anymore, Mercado Libre. These are 6, 7, 8, 10% positions for me, not because I picked them, the market picked them. The companies did so well, went up so much that they earned a higher and higher spot in my portfolio. Conversely, some companies that I own that have been huge losers, right, down 50, 60, 70, 80%, I may have put 1% of my capital into them, and now they're like 0.1% of my capital. So they're irrelevant to the future prosperity of my portfolio. So that's a style that works for me. I do all my work upfront to try and find the highest quality companies that I can find, trading at the best valuations that I can, trading with the most long-term potential. I continually buy those companies, and then I let the companies do the work from there. And the companies that execute and their stocks go up get a higher and higher percentage of my invested portfolio, and the stocks that don't fade away into obscurity. So amongst, while I've owned 80 stocks, I would say the bottom 20 are probably combined 5% of my capital, and the top 20 are combined 60% of my capital, or something along those lines. So I'm more concentrated than it would appear. But the important thing there is the winners in my portfolio earned their positions, and the losers earned their position. And that's how I mitigate the risk of, what if I'm wrong? What if my analysis is incorrect? Which it often is, right? I'm doing my best to make guesses about the future, and I'm doing my best to put the odds of success on my side. But no matter what, it's still a game of odds.
100%. So I'm gonna switch gears for a second. I'm gonna switch out of finance and back to the personal. Your favorite city is Boston. I recognize that you pretty much grew up in Rhode Island, so you're up there in the Northeast. Well, why Boston? Boston has enough fans.
Because you made me pick one. And I said, all right, of all the ones that out there, I like Boston the best, because I can drive to it, because there's a lot to see there, because there's great food, there's great entertainment. It's a wonderful, wonderful city. But that's like, you made me pick a city that's my favorite. I recently went to Austin, Texas. I loved it. I had a great time. I've been to San Diego. Loved it. Had a great time. I'm heading to San Francisco in a couple days. I've been there before. Great town. Had a great time. I go to Florida regularly. I love North Carolina. There are so many awesome cities out there, and I try and go to many of them. But if you're like, put a gun to my head and say, pick your favorite, I guess I'm going to go with Boston.
Okay. So are you a Boston sports fan too?
Yes.
Okay. Well, then it makes sense. I give you that one. You're the first person, by the way, when I asked about last meal, where that had wonton soup in the lineup. Where's the love of wonton come from?
I love Asian food. I love Japanese. I love Chinese. I love Thai. I love Vietnamese. To me, that is just my favorite ethnicity of food. I don't even know how to describe it.
Yeah, sure.
And those foods, I have the hardest time recreating at my house. It's relatively easy for me to make Mexican. It's relatively easy for me to make Italian. Obviously, American is super easy to make. But Asian food, I have the hardest time recreating. So if I'm going to be going out and spending money at a restaurant, it's almost always going to be an Asian restaurant that I can't recreate that as well from home. And I was just thinking, what would I want? I love wonton soup as an appetizer, but it would probably be some form of Thai food that I would have.
Well, I also asked you what your spicy preference was, and you said Thai hot, which is, just makes you a man after my own stomach. I love spicy, and I love Thai as well.
So good.
So I asked about a financial crisis. And it's something I ask of all the guests. And, what's interesting is the number of people that actually say never had one. But like you, I've had them. And you said you were broke in college. Can you just talk about that for a second, and what that was like, and how that then influenced what it is you do for a living today?
Sure. So I think we're all born with natural proclivities towards saving, spending continuum. I am naturally born to be a saver. That's a very natural thing for me to do. And whenever I had money, I just had a natural ability to save it. Like, that was something that I've always, it hasn't been hard for me to do. When I was in college, my freshman year of college, I went in with maybe a few $100s, maybe $1,000. And if you know about college, you know that there's lots of things you could spend money on, and not a lot of ways that you make money. You're busy with other things. So I vividly remember 3/4 of the way through my freshman year, my bank account was literally like $13. Or something like that. And I had no way to get money. And at the time, I obviously still wanted to go out and party, and I literally couldn't afford beer. And it was just awful, awful that I had to go to my friends and be like, can I borrow $20. I'll pay you back somehow magically once I get money in my life, but I have no money in my life right now. And I had to do this for like 3 weeks in a row. And the first time, it's no big deal. The second time, they're kind of like, all right. And the third time, they're like, really? Really? You know what I mean? And I just remember the awful feeling that I had of being desperate to be able to borrow money from a friend to buy the necessities of college. All right. So after that, that wasn't a financial tragedy at all. Like, it wasn't, right? I was never like at risk of being thrown out of housing or not getting food or anything like that. But I can tell you, it felt awful. And it left mental scars on me. And from then, I made a vow to myself that I would never, ever be broke again. I don't care what that it took. And I think that in some small way has informed the view of money that I take today, which is avoiding debt and making your personal finances as rock solid as you possibly can be, because I never want to be in that position again.
I can really appreciate that. So how old are your kids, Brian?
They are 12, 10, and 8.
And do they know what you do?
Sort of. I still don't really know what I do.
Well, what's a game of Monopoly like in the Feroldi house?
It's pretty interesting. They understand the strategy pretty well. We love playing games, so that's a good one for teaching. I think that Settlers of Catan and Ticket to Ride teach money just as well, even though you're actually not using money. But that's one wonderful thing about games. Anything with strategy and thinking through and resources and economy, a lot of those games have them built into them, not just Monopoly. But Monopoly is obviously a classic one.
And are you teaching already? Like, I don't know if you, my kids are out of the house, and I'm sure I didn't do a good job of this, and I'm playing catch up. But do they have a way to earn money? And then are you enforcing savings, spending? Are you doing that already?
So I think I know that all the most important money lessons that I learned the hard way. And like, for example, if my parents forced me to save, if they forced me to do anything, I would never have been flat broke in college. And if I wasn't flat broke in college, I wouldn't have the mindset that I do today. But I think that you learn from your parents by watching what they do, not necessarily by what they say. So if they have questions for me about money, I'll obviously be very open and honest with them and kind of give them some guidance. We do have ways that they can earn a little bit of money, and we signed up for this product called Greenlight, which is like they get debit cards that are like associated with an app, so like allowance goes on there. And the one thing that's been, I think I've done right with that money, is every time we go on vacation, I put a $20 bill in their hand and I say, here's your vacation money. It's amazing how they make rational decisions. Yep. once it's their money. I vividly remember being on vacation with my daughter in New Hampshire, and she wanted some shiny rock. Okay, it was like a glittering rock, and she was in the gift shop of this this town, and this rock was $3.99, and she thought it was $3. And she walked up there to pay for it, and she didn't understand the 99 part and then the taxes part. And they said, okay, that'll be $4.27. And she said, never mind, I don't want it. And it was like, okay, to you, that thing was worth exactly $3, but it wasn't worth $4.27. And she went and put it back. And it was like, see, it's amazing how people make kids make rational choices when they actually have the money in their hand and it's a finite resource and they get to manage. So I think that that's a great thing to do, is to put cash in your kids' hands on vacation in particular, because then it's an experiment. And I actually have like crossed my fingers that they would spend it on like video games or food, and they would like blow it all in the first day so that then they could go the rest of the vacation and not get anything. But they're all naturally, like, by the end, they all still have money left. So I think that they're just naturally going to be a saver mindset, and they save it for like the future things so they can buy like stuffed animals or whatever interests them. But
well, there's certainly nature nurture going on. I think kids are sponges. They probably see even more than you think they see. And just anecdotally, I'll share in a similar vein. I remember giving my kids some money also when going on vacation and going through the airport. And the first time when my son was going to buy a bottle of water in the airport, and then he saw how much it was. And I said, "Why didn't you get the water?" He said, "I just drink the free water on the plane."
There you go.
I was like, "Good answer."
There you go.
Okay.
Yep. And now just going through the grocery store I think is very, very useful. And you like yesterday I was at the grocery store with my son, and we were looking at store brand Cheerios versus brand name Cheerios, and we looked at the price per pound, and it was literally like $6 per pound or $6 per unit price for the branded Cheerios and $2.50 for the store brand. And I was like, I was like, oh my God, Cheerios are $6? Who's paying that? I was like, yeah, you get it.
Yeah, now you get it. Got to look at the per ounce cost.
That's right.
Hey, Brian, I really enjoyed this. I really enjoyed meeting you, and I want to thank you again for taking the time to be on the All Together show. Thanks for spending time with us.
Great to meet you, Eric, and thanks for having me.
The All Together show is brought to you by Alto. Alto knows that achieving true portfolio diversification means investing in more than just stocks and bonds. That's why Alto developed a streamlined platform to make it easy and cost-effective to invest tax-advantaged retirement savings in alternatives, assets like real estate, venture capital, and crypto that are outside of the public markets and available through Alto's growing list of investment partners. To learn more, visit altoira.com/altogether.